When you look at the accounting statements for various companies, there are two major statements. One is the balance sheet, where we study the assets and liabilities, and second is the profit and loss account, where we study when we note down the income and expenses. So these four become the pillar of personal finances: assets, liabilities, income and expenses. The structure of assets and liabilities may keep changing as you pay off the loans, or if you keep taking more loans. The basic idea behind asset allocation is how do you allocate money in different assets, different investments, and that is done with the purpose of managing those risks. It's done with the purpose of balancing between the safety, liquidity, and returns requirements in line with our own goals. Asset allocation and a four-step process. You identify the needs which is in line with the goals. Understand that if you want higher returns, then you will have to take certain risks. However, if you do not want to take risks, then inflation is anyway there, and then decide what kind of risk that you want to take. And then there are asset classes. So equity is associated with volatility, real estate is associated with illiquidity, debt or bonds and debentures and fixed deposits are associated with credit, and when you want to avoid all the three, whatever is left is associated with inflation. So choose how much risk to take and which, and that's where you decide where do you put your money. Once that broad plan is done, what do you buy within? That is more fine-tuning. The needs are unique, but they also keep changing. The assumptions also keep changing, and from that point of view, every year or once every 2 years, you must do a review of your situation, your finances, and your investment portfolios. When you look at all these four, remember that especially the income and expenses, many of us are working to earn and earning something out of that work. So that is the income are coming from whatever occupation we are in. Whatever is your occupation, that income is coming here. There are essential expenses mandatory, and there are discretionary expenses which are non-mandatory in nature. Income minus expenses equal to savings, and these savings go into investments. Okay, so this is the basic simple straight line cash flow. Income coming from whatever occupation we are in actually is a much larger component of income compared to what comes from the investment for a significantly large part of working life. Once you retire, then your occupation income stops. You don't work for money. Change the equation from income minus expenses equal to savings to income minus savings equal to expenses. The essential expenses must be incurred before you can start saving. All the financial goals that we talk about are nothing but expenses to be incurred in future. So the expenditures that we talked about are mandatory short-term expenses would come here. Discretionary short-term expenses would be the short-term goals. And then there will be all the long-term goals, which could be, some of them are mandatory, some of them are discretionary, and of course there will be some medium-term goals also. The purpose of investments is to meet these financial goals. However, since there are some long-term goals and some medium-term goals, not all goals need to be funded immediately. So what do you do with that investment? Whatever income is generated out of those investments, that gets added to this income. And this is nothing but what we call compounding of investment returns. It takes decades for the investment to grow to a substantial size. That's why the occupation income has to be first protected.